Welcome to the Deep Dive. Today, we're tackling a huge question, digging into just a massive stack of sources. We've got academic papers, numismatic society records, financial institution projections, all focused on gold versus Bitcoin.
Yeah, and the key here is the scope. We're not just looking back 10 or 15 years. Our sources push us to analyze this across, believe it or not, 2,125 years.
Yeah.
We're going from Imperial Rome, the year zero, all the way out to projected futures in 2125.
It's ambitious. The idea is to really extract the core insights from this huge timeline. You've got gold, the 5,000-year-old anchor, versus Bitcoin, the, 16-year-old digital upstart.
Exactly, two fundamentally different assets. Let's see what this deep dive uncovers.
Okay, let's start with gold, the historical anchor. Forget 1971 for a second. What do those first 1,500 years, starting way back in year zero, tell us?
Well, what's really fascinating and kind of crucial to get is that gold's price back in the Roman Empire, it wasn't really about gold gaining value itself. It was more like a mirror reflecting the decay of their fiat currency.
So it was a measuring stick.
Precisely. Under Emperor Augustus, year zero-ish, an ounce of gold was worth about, let's say, $35 in today's money equivalent.
And that held for a while.
Reasonably stable, yeah, until the government started messing with the coinage, debasing it. Gold then becomes this reliable indicator of state instability. By 211 AD, Marcus Aurelius Antoninus, the equivalent price creeps up to maybe $42 an ounce.
Okay.
But the real kicker is the hyperinflation. You see signals with the Edict of Diocletian, the Constantinian reforms. By the early 4th century, you're looking at something closer to $65 an ounce equivalent.
Wow, so almost double in 300 years. And that's not gold getting better, it's the Roman denarius getting worse, right?
Yep.
Less silver, less copper.
Exactly. Gold was the stability. It proved its value as that ultimate hedge against, well, government-driven economic problems. And that reputation, that credibility, it carried right through the medieval period.
Then we get to the modern era, the gold standard. Things seem stable again for a time.
Yeah, the 1800s formalized it, fixing the price around $20.67 by 1900. But the 20th century brought two major shocks to that system.
First was the U.S. Gold Reserve Act in '34, fixing it at $35 an ounce, kind of the last anchor hold.
Pretty much. And then came the big one, the Nixon shock in 1971. This is where the U.S. just, well, unilaterally cut the direct link between the dollar and gold. The Bretton Woods system was effectively over.
So no more swapping dollars for gold at that fixed rate for foreign banks?
Nope. And that's the moment gold was set free, allowed to float. Its true volatility driven by markets, fear, speculation, it all came flooding back.
And flood back it did. That 1980 rally was wild, hitting $850 an ounce at its peak. But it couldn't last.
No, it couldn't. It corrected hard, eventually hitting a low point post-standard of just $279 an ounce in the year 2000. That's really our modern starting line for this comparison.
Right, and since 2000, it's been mostly up.
Definitely. The 21st century has seen this boom fueled by, global crises, wars, lots of money printing. We saw $872 during the 2008 crash.
Yeah, I remember that. And then $7,770 during the start of COVID. So where did the sources put it now for 2025?
The data points to a continuous historical maximum for 2025.
Right.
$3,450 per ounce. Since that 2000 low, that's a total return of over 1,100%, about 10.3% compounded annually. It just shows even now gold's power as that physical trusted reserve is still incredibly strong.
Okay, now let's flip to Bitcoin, because its history is just a rut. It completely rewrites the timescale we were just talking about. 16 years fitting into a tiny slice of gold's timeline. That origin price is almost hard to believe.
It really is. Genesis price 2009, 0.00099, like less than a tenth of a cent.
The best illustration is still that Bitcoin Pizza Day story, right? 10,000 Bitcoin for 2 pizzas, worth about $41 then.
Which is billions today.
Billions. Someone literally traded billions of dollars, future value, for dinner. It perfectly shows how adoption starts from basically zero perceived value. It's wild.
It is. So if gold's story is stability against fiat decay, what defines Bitcoin's explosive early years? What are the key drivers? Well, it seems to be driven by crises and these built-in supply shocks. Our sources kind of break it down into four main stages. First was early adoption. Think 2013, the Cyprus banking crisis. That really highlighted Bitcoin as this censorship-resistant thing outside the banks. Price jumped to $770. That's almost 6,000% in a year.
Insane growth. But then came the volatility, the boom and crash era, 2017, everyone remembers.
Yeah, that was necessary pain, you could argue. The price rockets to $13,850, grabs global headlines, but then the crypto winter hits. A brutal 73% crash down to around $3,700 in 2018. It showed both its potential for crazy growth and, well, its potential for violent corrections.
Okay, but that volatility eventually led into what the sources call the institutional era, maybe around 2020. What changed?
Two big things, really. Growing institutional interest and, crucially, the third halving in 2020. The halving is key for Bitcoin. Every 4 years, the new supply entering the market gets cut in half, programmatically.
Ah, the built-in scarcity.
Exactly. That supply shock, combined with all the COVID liquidity sloshing around, helped push the price to over $29,000 by the end of 2020.
And then 2024 brought more milestones. The fourth halving, cutting the reward again, plus the US finally approving spot ETX. That pushed it into six figures.
Absolutely. And this brings us to the headline number, the one that just boggles the mind. From that 0.000000999 price in 2009 to the current 2025 price of $110,723. The total return is over 111 billion%.
It's a number that doesn't even compute. How do you even contextualize 11,183,133,233% growth?
Yes, tough. Basically, a $1 investment in 2009 would be worth over $1.1 billion today. It's a growth rate that just breaks traditional financial models. We have to use different ways to even assess it compared to gold. And remember, this thing is divisible into 100 million tiny pieces called satoshis. Achieving that velocity in 16 years, it's just a fundamental shift.
Okay, let's put them side by side now. Bitcoin's velocity versus gold's stability. How fast did Bitcoin actually close that value gap?
The clearest way to see this is the ratio BT Tero Bitcoin price divided by gold price. Back in 2009, it was effectively zero, like 0.0000001x. Totally irrelevant.
Right.
By 2017, just 8 years later, it crosses the line. One Bitcoin becomes worth 11 times the price of an ounce of gold.
And now, 2025, with Bitcoin at $110,722 and gold at $3,450, and that ratio is 32.1x. One Bitcoin is worth 32 ounces of gold.
That speed is just
Oh,
unprecedented. But, and this is important, the source material did flag a really interesting recent anomaly, a short-term reversal.
What's that?
Well, even though Bitcoin's return since day one absolutely crushes gold like 44.4 million times better, in the very last year analyzed, 2024 to 2025, gold actually beat Bitcoin.
Really? But with the ETFs and the halving for Bitcoin?
Yeah. Gold surged 78%, while Bitcoin only did 54%. It really highlights Bitcoin's big vulnerability, that extreme volatility. Gold's jump was likely driven by geopolitical worries, central bank buying, folks running to perceived safety with near zero counterparty risk. When stability is king, gold still shines. It's a reminder Bitcoin is still highly speculative, even with Wall Street jumping in.
Okay, that makes sense. Now let's look further out, the 100-year projections, out to 2125. What's the sort of consensus view, the moderate scenario from these financial institutions?
Right, and we have to stress, these are highly speculative models. They're basically compounding current trends and scarcity assumptions way out into the future. But the moderate projection puts gold at $90,000 per ounce in 2125.
Okay.
That's about a 2,500% return from today, basically assuming gold keeps its historical 3.4% annual growth rate.
And the big one, Bitcoin, the $20 million number.
Yeah, that's the moderate projection. $20,000 per BTC. That would be an almost 18,000% return from today's price.
Wow. What's the thinking behind that?
It assumes, increasing global adoption, that it successfully navigates the regulatory minefield, and that the built-in scarcity keeps driving the price. It implies about a 5.4% annual growth rate. Still strong, but obviously way slower than the hyper-growth phase we've seen.
So even a century out, Bitcoin's projected to stay dominant in value terms. That ratio balloons out to over 222 times Bitcoin per ounce of gold.
That's what the moderate model suggests. And just quickly, there are more extreme optimistic scenarios out there, especially from pure stock-to-flow believers, talking about Bitcoin hitting $1 billion and gold maybe $150,000. But the main point across most models is both are expected to grow significantly, just at really different speeds.
Let's dig into the why behind those numbers, the fundamental strengths and risks. What keeps gold relevant for the next 100 years? What are its core advantages?
Gold's strength is really its physical reality and its deep history. You're talking 5,000 plus years. It's recognized everywhere. Doesn't need electricity or the internet. And crucially, central banks hold what? Over 35,000 tons of it? It's baked into the traditional financial system as the reserve asset.
And Bitcoin's strengths are almost the mirror image, right? Intangible, digital.
Exactly. Its value comes from math. That hard-coded limit of 21 million coins, ever. Its decentralization, no single government or bank can truly control or seize it easily. And you can send it anywhere instantly, permissionlessly. It's a parallel financial network.
Okay, but with these massive projections, the risks have to be just as significant. What could genuinely threaten gold's position?
For gold, the risks are kind of external, physical. The biggest ones are like a huge, unexpected new gold mine discovery somewhere easily accessible. Or the sci-fi sounding one, space mining. If someone actually manages to mine gold from an asteroid and bring it back cheaply, that could massively increase supply and hit the price.
Right. And for Bitcoin, the risks feel more internal, regulatory, technological.
Definitely. The sources are pretty clear on this. There is a very high H risk from governments. Regulation. Countries don't generally like losing control over money. That's still seen as the biggest existential threat. And then there are the tech risks, potential vulnerabilities in the code, or the big one looming down the road, quantum computing. If quantum computers get powerful enough, could they break Bitcoin's encryption? It's a threat.
So weighing all that strengths, risks, projections, what's the most likely outcome according to this analysis? Do they coexist? Does one win? Does one fail?
The most probable scenario, based on the sources, is coexistence. They give that about a 40–50% probability. The idea is gold keeps its role as the traditional physical reserve, like by central banks in older systems, while Bitcoin becomes solidified as digital gold, the reserve asset for the digital borderless economy. They serve different needs.
So that suggests the scenario where Bitcoin totally takes over, hits those wild billion-dollar targets, and replaces gold. That's actually seen as less likely.
Yeah, significantly less likely. The analysis puts Bitcoin total dominance at only a 10–20% chance. This is really key. While the upside projections grab headlines, the analysis also shows a pretty substantial probability, maybe 30–40%, that Bitcoin could still fail completely. Maybe due to killer regulation, maybe a better technology comes along. It's still very much high risk, high reward.
Okay, this whole deep dive gives us a really clear picture. Gold, stability, a hedge against the traditional system breaking down. Bitcoin, potentially exponential growth, disruptive, but much riskier. So for you listening, trying to make sense of this quickly, how does this translate into maybe thinking about allocation?
Well, the sources did offer some helpful models, depending on your own risk appetite. If you see yourself as conservative, you want that stability, but maybe a little exposure to growth. The suggestion is something like 70% gold, 30% Bitcoin. You're anchored, but still have stake in the disruption.
Okay, and for someone more in the middle, a moderate approach.
The data pointed towards a 50–50 split as potentially offering a good balanced exposure to both the traditional store of value and the potential digital future. And of course, if you're aggressive, you really believe in the disruptive potential and can handle the wild swings, so you'd flip it. Maybe 30% gold, 70% Bitcoin.
That framework kind of neatly wraps up 2,000 years of history and 100 years of speculation.
It does. But here's the final thought, the thing to maybe mull over yourself. We spent all this time projecting 100 years out, right? But just remember, Bitcoin didn't even exist until 2009. Our projections don't really factor in, major geopolitical upheavals, sudden tech leaps we can't imagine, or completely new assets that haven't been invented yet. If Bitcoin could emerge after 5,000 years of gold being dominant, what totally unforeseen disruptive technology or asset might appear in, say, 2045 that suddenly makes both gold, Bitcoin look like those old Roman coins we started with? That's the ultimate question, isn't it?